March 20th, 2020, the S&P 500 was at 2,300 during the bottom of the COVID correction. Since then, it has skyrocketed to 4,455, up 65% in 18 months. The S&P 500 is sitting around all-time highs, and you can't throw a rock without hitting somebody and them telling you about how much money they've made off Tesla and this new NFT. But you can't also throw a different rock and hit somebody else who's saying that the stock market is overvalued and ready to crash. Old Uncle Warren Buffett, back in 2001, gave an interview to Fortune magazine, and he told us about a ratio or an indicator, and he called it probably the best single measure of where valuations stand at any given moment. Since then, it's been called the Warren Buffett Indicator. Now, the Warren Buffett Indicator, it is market cap of all the US-based stocks divided by GDP. To get the market cap, we use the Wilshire 5000 index. This is essentially all the US-based publicly traded stocks. Now, it's not 5,000 stocks, it's only 3,500 stocks, but it used to have 5,000 when they named this thing. And you can look at this index, and it's measured in billions. So the total market cap is $46.3 trillion. Divide this by GDP. The GDP is essentially all the goods and services created in the United States for the year. This number is about 22.7 trillion. So we have 46.3 divide 22.7. We get 2.04, multiply that by 100 to get 204%. That is the Warren Buffett Indicator. That's where it's at now, 204%. And this is an all-time high for this indicator. But we need a little more context on how high this number is. So let's go ahead and take a look. Back in 1971, this index was at about 80% for a few years. Then it fell down to 40% in 1975. It worked its way up over the next 20 years to 60%. And then it skyrocketed to 140% in 2020. That's when the dot-com bubble crashed. The Nasdaq fell 78% and the S&P 500 fell 42% in the next 2.5 years. And this put the Buffett Indicator at about 70%. It then peaked again during the financial crisis in 2008 at 106% and fell down to 49% where it bottomed out. Now, it's been consistently trending upwards ever since, except for a dip during the COVID correction. The long-term average is about 85%, and it fell below this during the dot-com bubble and the financial crisis in 2008. Now, if stocks were to fall, the Wilshire 5000 would need to fall 62% to reach that 85% long-term average. But the economy's changed a lot over the past few years, and technology has made companies a lot more efficient over time. Companies are able to evolve and grow much faster than they did, say, back in the 80s. The website Current Market Valuations does a great job of adding an historical trend line to this indicator, so we can better see how this indicator changes over time. And that would suggest that fairly valued would be around 120% nowadays. This gives us a decline of only 41% to reach fair value. But one of the most important factors when deciding valuation is interest rates. Warren Buffett said interest rates are to valuation as gravity is to matter. The lower the interest rates, the higher the possible valuations.
Well, it gets back to something fundamental in investments. I mean, interest rates, basically are to the value of assets what gravity is to matter, essentially. And
when you hear about the Fed raising interest rates, they're talking about how much money it costs for the banks to borrow money. They borrow money for say 1% and lend it out again to maybe 5%, and they keep the difference. And this spreads out to the entire economy. This adds to the supply of money, and the more money in circulation, naturally more money is going to end up chasing stocks, and that will drive prices a bit higher. Another reason is that bonds are more closely correlated to interest rates than stocks are. If interest rates are high, you can invest money into treasury bonds or safer assets for an acceptable return. But if interest rates are low, your return on those bonds is going to be lower too. Like now, they're almost zero. So buying bonds, you're almost going to get zero return. Then this forces you to buy more risky assets for that acceptable return on your money. Money that would otherwise go into bonds will now go into stocks and keep those valuations higher. Even though Warren Buffett called it probably the best single measure of where valuations stand at any given moment, no indicator is perfect and foolproof. The Buffett Indicator may tell you that stock market is overvalued compared to GDP, but doesn't tell you that the stock market will crash. The stock market can become more overvalued, or it can stay overvalued for longer than investors think possible. The indicator's been over 100% since 2013, and the market itself does not care what the indicator thinks it should do. There are other factors that we need to take into account, such as how interest rates affect supply of money and investor choices, and there isn't any concrete unbreakable rule about how high valuations can go, or what indicator is the best. Just because the Warren Buffett Indicator says stocks are overvalued does not mean Warren Buffett himself is selling all his shares and waiting for the crash. It is always best to stay diversified in different asset classes and have a long-term outlook when investing in stocks. In investing in individual companies, you got to do your research and understand how the company will manage if the economy goes sour. Investing and building wealth are a marathon, not a sprint. And don't let Wall Street bets distract you into making money fast. Investing in quality stocks for the long term, like Warren Buffett does, is still the best way for investors to build wealth in the stock market. I'd like to know what you think. Is Warren Buffett the most valuable indicator, or is it even as valuable as all these others make it out to seem? Especially when considering things like interest rates and things like long-term investing and dollar cost averaging. Please hit the like button if you're still watching. Subscribe for more videos every week, and I think that's all I got for this week. Justin out.